Facebook is a long-term quality with sound fundamental and exceptional financial company. But why do I not recommend to buy now? Hi guys, my name is Ethan. Welcome to my investing channel. I believe you clicked into this video is because you are either a Facebook share owner or you intend to buy Facebook shares soon. Either way, please allow me to explain it. It is a bad idea to buy Facebook shares right now. Number one reason is because the market is going through a correction phase and will probably stay in this phase for a while after a long period of euphoria. And number two, Warren Buffett, our guru of investing, is offloading shares in the United States like nobody's business. This means that he has no confidence in the market, at least for the short term. And number three, the upcoming US election in November will create many uncertainties in the market, and these uncertainties has high possibility of resulting in a sell-off, which will impact Facebook shares heavily, as Facebook has experienced tremendous growth of 102% since April. Short period of high growth usually comes with a huge decline if uncertainties strikes. And number four, there is no foreseeable catalyst in the short term to boost Facebook shares to break its strong resistance level at $300 per share, but face an immediate downside risk of 9% to $260 per share. However, it is not all doom and gloom, as all these are only temporary smokescreen until the election is over, and there are three good reasons why I will buy Facebook shares after the election. Number one, my valuation model actually shows that Facebook is priced at $332.22 per share, equivalent to 17.5% upside potential. And number two, there are many potentials yet to be unlocked. For example, WhatsApp, Insta, Facebook Watch, and many more. And last but not least, the exceptional financial performance over the years, and Facebook has a juicy 80% gross profit margin. Please note that as I'm recording this video, Facebook shares is priced at $282.73 per share. If you want to know more, stay tuned. Anyways, before we jump into today's topic, a quick intro about myself. I used to practice corporate finance as a profession for some years, and I hold CFA and ACCA professional qualifications to my name. My job back then taught me how to value a company. Yes, I know how to value a company, period. And I'm going to use these skills that I've acquired to share with you guys how it helps me to identify my target price for Facebook. Now, I would like to provide an overview of how an informed investor should go about in order to value a share. Step 1. Look at the company financials. The numbers don't lie. We will briefly look at the numbers later in this video. Step 2. Read management quarterly or annual report to understand what lies ahead for the company. Also be mindful of the risks that the company may face. We will also need to be able to distinguish what is dream talking and what can ultimately translate into profit for the company. Step 3. Analyze. We will have to gather our thoughts after all the heavy reading. But don't worry, I will summarize my findings for Facebook in this video, so you could just sit back, relax and eat a Kit Kat. We then have to figure out the realistic assumptions for the company and insert those assumptions into the DCF model to derive at a target price and ultimately benchmark to its current price. Before I go further, I want to give you a surprise. If you subscribe to my channel, I'm going to share with you my valuation model for free. If you are not familiar what a DCF model or a market multiple model is, I will do a tutorial on the models if I can get 1k subs for this channel. Yep, that's right. That's the fee for me to make a tutorial for you guys, which is essentially free of charge. Nevertheless, if you so wish to obtain the model, which I'm about to show you, please drop me a comment down below and I will share the model with you privately as for now, because I do not know how to share it via YouTube. It is entirely free and the numbers are all populated by myself. It is all hard work, so I would be truly appreciate if you could subscribe and give me a thumbs up. So without further ado, let's face the book together, shall we? Now I'll be going through the company financials with you, and it will be quite heavy if you have not seen Facebook financials report. But please bear with me for a little while. So let's get started. Every company main objective is to make money, right? So we need to know how Facebook make their money. Here you can see the Facebook's revenue consists of advertising and others. And obviously, advertising is the main revenue driver here. Others here refer to Oculus and Proto products, which also show quite an exciting growth, but the numbers, however, are relatively insignificant as compared to the advertising revenue. Down below, they also show you the Facebook daily active user, monthly active user, family daily active people, and so on. And the numbers are like 12% to 15% at a low double-digit growth for active users. When we look at revenue driver, the deconstructed form will be the price multiplied by the volume equals to sales. So in the case of Facebook, the price will be Facebook average revenue per user, in short ARPU, and then we multiply the volume. The volume here refers to the number of active users, be it daily or monthly. All these can be found in their earnings report, which I have extracted here for you. Now, listen carefully, because I'm about to tell you something great. Here, you can see the average revenue per user. Highest is in the US and Canada region. It's about 36 USD, while Facebook active users mainly comes from the Asia Pacific. But if you look at the revenue breakdown by geography, you will notice that the main revenue contributor is actually from the US and Canada region. Poof! Mind blown. So moving forward, Facebook will be able to generate much more revenue by simply charging other regions higher. It is as simple as that. I'm just kidding. This obviously is easier said than done, because there are likely cheaper alternatives for digital marketing in the other regions, which is why they are currently charging so cheaply. So in order to have better gauge if Facebook can do better in the future, we need to understand marketing budgets in other regions by researching to see if we are able to compare the price of digital marketing in the rest of the world. This will give ourselves a better understanding of the potential of Facebook. Will they be able to continue to achieve double-digit growth and a juicy 80% gross profit margin in the future? Will highly dependent on this assumption. Now, let's look at what Mark Zuckerberg has to say. There are now more than 3.1 billion people using their services and 180 million businesses. I mean, whoa, this is a huge number. I would say Facebook is one of the top digital marketing platforms in the world, hands down. But with that in mind, how much more growth do you think they can achieve in terms of the number of active users, be it monthly or daily? Something for us to ponder about. Then he goes on and talks about how people wrongly assume most of their service is about politics, news, misinformation, and hate. This part here, I would say he's just doing his CEO job to dispel any negative news of the company. Nothing much about the valuation of the company. Come on MZ, you can do better than this. Anyway, let's move on to what Dave Webner, the CEO of Facebook, have to say. Here he highlighted something very important. He said that the average price per ad have declined by 21%, and the decline is largely attributable to the economic impact of the pandemic, although they saw year-on-year pricing trends improve in the latter part of the quarter. This is a crucial piece of information because remember what we learned earlier. The average price per user, aka ARPU, has bigger impact to the revenue growth than the growth in active users. We need to pay attention to this and see, does the ARPU recovers in the next quarter? If not, I will need to tweak the revenue growth downwards, which will result in a lower valuation. But the tweak will be a simple one, and we will be able to revise the target price quite fast if other variables remain constant using my model. He also mentioned about other revenue, which we saw earlier in the earnings report. The other revenue went up by 40% to 366 million USD, which is still considered insignificant to move the needle for Facebook. However, If this amount continues to grow with high double-digit growth, we may have a catalyst for Facebook price to soar to a high level. So this will be another key focus in the next earnings report. Next, I want to talk about how Facebook becomes a giant tech company with 800 billion market capitalization, and it all boils down to one word: innovation. Facebook has since inception been innovating its way to the market, from a private social page to Facebook social media today, acquiring both WhatsApp and Instagram for future expansion, as they saw these two companies are able to provide synergy to Facebook core business as a social media platform. Then Facebook created Facebook Watch to compete with the likes of Netflix, and launched Instagram Reels to compete with the recent hype app TikTok. Not to mention they are also in virtual gaming space, Oculus, which is going to be the next cash cow for Facebook in the next few years. And lastly, Facebook Portal, which is a brand of smart displays and video phones but isn't doing that great according to Dave. Honestly, I think they have been on an exciting journey and will continue to provide excitement not only to their customers but also to investors like us. Finally, we arrive at a session where I will show you briefly how my model works. This is how my valuation model looks like. It is also known as a discounting cash flow. Let me zoom in for a little. I have put in all the assumption historical numbers in the model. The black colored cells are where you need to input numbers, date according to the description, and the 5 years will be the historical numbers until 2019. 2020 is based on Q2 result, which I have multiplied by 2 to make it a yearly number. As I mentioned before, based on my current assumption, the target price is at 332.22, which is an upside potential of 17.5% based on current price of 282.73. Now, there is an issue when using DCF model. The target price is highly sensitive to the assumptions that you use. For example, if I assume Facebook will only achieve 10% growth rate moving forward, here the target price will change to 302.18, which is only about 7% upside potential. You can also counter check the assumptions with analyst assumption, which can be found in many websites. For example, FinWiz, you can check your assumptions against the forward PE here, which states 27.92, whereas my model shows 27.5. Or you can also compare the EPS next year, which shows 10.13 against my model of 10.27. This means that our earnings estimation is rather similar. In essence, you gotta be an informed investor to be able to use these two efficiently. It may be hard for you to use the model now, but I will be doing more analysis on other companies using the valuation model. If you follow my channel, you will be able to download my model, which I use to analyze different companies moving forward. Then I'm sure you will be able to understand the tricks to using this amazing tool. I do not want to go over how to use the model in this video. Like I said at the beginning of my video, 1k subs and thumbs up, and I will do a tutorial on how to use the model. I will also disclose all my references or sources on where you can refer to for the numbers and assumptions to make sure the model is as accurate as possible. For the purpose of this video, I will just go through one high-level assumptions I have for Facebook. I'm currently assuming 12% revenue every year for the next 6 years. How do I derive this number? Do you recall in the second quarterly report that it mentioned low double-digit growth in Facebook active users? Yes, I know. 12% growth in active users does not mean 12% growth in revenue. But hey, Facebook have been growing rapidly for the last few years, and 12% is a rather conservative growth. If you look at the historical revenue growth here, as I highlighted, the historical revenue growth ranges from 13% to 47%. So I would say 12% is a rather conservative growth rate. But I'm just being prudent in my model, and with that the model is telling me that Facebook worth more than what it is today. You can also adjust the historical growth rate to show a list of things here: cost of sales, EBIT, or PAT. Now, let's look at the market multiple. For this, we need to benchmark Facebook with direct competitors if possible. In this case, I have used Google and Amazon. Google and Amazon are both larger than Facebook, even though they are all considered as tech giants. Again, the black colored cell are the information that you need to input. The results are reflected at the last few columns. We have price to sales, enterprise value over EBITDA, enterprise value over EBIT, and finally price to earnings ratio. All this information will be reflected in the first tab of the model for convenience sake. Right at the bottom of the first tab, right here, where you can see company name, PE, company name, PS, company name, EV, EBITDA. So, with all this said and done, I know my model shows that Facebook is currently underpriced, but yet I said do not buy now. That's because the model can only provide a target price as a guidance. It does not provide guidance in terms of timing the market. For now, my humble 2 cents is that the market will go into a week-long correction phase as it had enjoyed a prolonged period of euphoria. And what goes up must come down. Last week, the market ended with a sharp decline, which is an indication of price correction. Another reason to hold back now is because of the November election in the States. The market is always moving up and down, and I recommend to go in at a much lower price when investors start to worry nearing the election date. Therefore, the lower price point will present itself in a week or two before November election. I have also mentioned at the beginning of my video that Warren Buffett had also offloaded many American shares. I believe he is also of the view that the US shares will be facing a downfall soon. Well, if you insist on purchasing the share based on its current valuation, after all that I've said, I wouldn't say no to you, but I would recommend you to average your entry cost over the next few months instead of going all in. Remember to also diversify your portfolio to various industries or various investments if possible. Timing is a true culprit why so many people lose their money in shares market. Timing is very difficult to predict. Therefore, the best policy to investing is to invest for long term. Buy the shares that you are truly proud to own. Then when the shares price drop, you will take the opportunity to own more shares by averaging down. Since I'm bearish for short term, I will hold more cash now and be ready when the stock market falls by more than 10%. Also, I personally felt that there is no catalyst for investors to rush into Facebook shares now. So the key here is to be patient and observe the market over the course of next 2 months. That concludes my video, and I hope you are able to learn a thing or two about valuation models. If you wish to know more about other shares and how I will apply my DCF model, please comment down below, and I will spend time to study the companies in the comment and provide my 2 cents in my next videos. Lastly, if you enjoyed what I have shared in this video, please help me by subscribing, like, and comment. Thank you, 감사합니다, arigatou gozaimasu, 谢谢, selamat, and bye bye.